Narendra, can you start, please?
Yeah. Ladies and gentlemen, good afternoon and welcome to this first webinar, a knowledge sharing session arranged by Greenback Advisory Services for the promoters, top management team and finance professionals of the corporates. Greenback is a 25-year young Forex and risk management advisory company having offices pan-India and a very energetic team who understand the needs of corporates and offer customized solutions. Today's session shall be conducted by our director and co-founder, Mr. Subramaniam Sharma. Popularly known as Subu in the industry, he is a stalwart in Forex and risk management. He is a chartered accountant by qualification, having blend of experience as a corporate treasury man and a consultant. His corporate career with Shaw Wallace, Ruchi Group, and Jindals make him exactly understand the issues faced by companies and solutions they need. Friends, we all Indians have point of views in two subjects, Indian cricket and Indian rupee. But like in cricket, we still listen to an expert commentator about proceedings of the game. Today, let's listen to an expert of Forex domain on the current economic crisis and the way forward. Over to Subbu.
Yeah, can you hear now?
Yeah.
Okay. Shall I start from the beginning?
Yes, please.
Okay. Good afternoon, friends, and I would like to welcome you all to this session on the subject of the FX issues caused, the pains and the problem caused due to this lockdown created by the COVID-19. Before that, I hope that every one of you, your family, your friends are all safe and have been taking care of yourself and endured this long lockdown, which has been unprecedented and which has not been seen any time in the past. The problems have been going on, and the lockdown has almost completed 1 month, and considering the number of cases which is increased, there are talk that it may get extended. But I hope that everyone are safe and taking care of themselves. In fact, if you see the numbers, it's very frightening. And if you see this issue has affected almost the entire globe at the same time, though the variance or the seriousness or the size of the impact are different. But yes, it is a concern, it's a pain, and it's an issue which has affected everyone. Though India is affected, but the number of cases or the number of deaths is not that alarming as we see in other countries where the measures have not been as strong or as strict compared to India. Having said that, the pandemic created by this COVID has resulted into a lot of pain across industries, across regions, and India has also got into this, and trade and businesses are also got affected by this. So, so in the background of this lockdown, all the industries have got affected. The production have come to a standstill. People movement have stopped. Both trade, domestic trade, cross-border trade, everything has got affected. The supply chain has got affected, and now a situation has reached where people are not sure where it's going to end or how we are going to start once this whole problem ends. But having gone through this lockdown, there has been pains, there has been problems which has affected the industries in different form, and trade has also been affected. So this session is basically to address the issues on the cross-border trade, basically on the exports and the imports, and the exporters and importers. Basically, from the exporters' perspectives, problems arising due to the cancellation of the export orders and non-shipment, and the resulting cancellation of the forward contract. The problem relating to non-utilization of the packing credit in foreign currency, which was drawn but not utilized, and the problem faced by importers due to lack of liquidity, where the import liabilities are coming in very soon. So I will start with the problems faced by the exporters and then the importer, then the what solutions and what we can do at this point of time, and how we should look at the things once things come back to normalcy post the COVID or lifting of the lockdown. I'm sure that the things are going to be very different post the COVID, or once things stabilizes or each country comes back to normalcy, which may be a different point of time. But yes, the way business is being done, the way transactions are organized, the way the relations, business relations are going to be there is going to take a big change. So corporates have to take steps to protect their business under the changed environment and revisit the way they do business, especially on the way they manage liquidity or they manage the currency risk. So having said that, let me first go to the problem faced by the importers. Let me go, or exporters first. Now, the first problem which exporters are facing are the payment which is not coming in, or the delayed inward remittances for shipments which have been done pre the COVID. In fact, the lockdown happened on the 24th of March, and after that there has been a complete shutdown of movement of goods. All flights have been cancelled, and the shipment has also stopped, and whatever goods have reached the buyer, they have not taken delivery, or they have taken delivery but have expressed their inability to make the payment. So that's a big issue on the liquidity side, which is resulting into money not coming on time, and also to that extent the forward contracts which are booked to take advantage, take the flows, are not being executed. Second is a large amount, and now having seen the delays in inward remittances or non-happening of future export, forward contracts which have been booked for those export realization have become a naked position, which are have to be cancelled. Now, the rupee has seen a sharp depreciation in the last 4 months, and anyway, in the even before the COVID, the rupee had depreciated around 3% from the beginning of the year, and post-COVID from March till now, the rupee has depreciated by around 500%. So overall, the rupee has depreciated by 8% since the beginning of the year, and it tested a low of almost 76.80. Of course, we saw a small pullback. Now, the forward contracts were booked somewhere in the beginning of year, say Jan, Feb, when the rupee was around 72, and now the rates are at 76. So there's going to be a large cancellation loss due to the rupees depreciation, because the dollars cannot be delivered and the forward contract have to be cancelled. So the most important problem faced by corporates are going to be the liquidity not coming in. Second is loss due to cancellation of forward contract. And more so, there has been order cancellation happening even after whatever orders were placed before, and where the shipment was to happen in April, May, those are all cancelled. So exporters are bundled with not only the liquidity issue, but also unsold stocks which are lying, and also loss due to the cancellation of forward contract. The other problem which the exporters are facing is the settlement of the PCFC. Now, corporates would have drawn a packing credit, and then against that, the export realization comes in, and that gets knocked out. Now, in case the export realization doesn't come in and the PCFC cycle gets over, the bank is going to crystallize the PCFC on the that will be treated as a rupee borrowing, and it will attract penal interest and also result into a higher cost. So all these are going to result into a bigger issues once situation improves, and companies would be starting with a big cash flow issue, big loss, and also big loss of business. So how do you address this? How do we go ahead in a situation like this is what is the concern of most of the exporters. So as we go ahead, we will also address some solutions which can be considered at this point of time to at least come over the current situation of loss on forward cancellation of forward contract and non-utilization of the PCFC. Now coming to the importers dilemma, just like exporters are affected on the liquidity side and also cancellation of forward contract, importers also are incurring say similar pains but of a different nature. FX loss is also going to be there because now after the rupee has depreciated due to this pandemic, the liability will be settled at a higher dollar rupee rate. That means in a month's time, the loss has gone up by almost 5% when they have to pay, or in future liabilities will be converted at the higher dollar rupee rate. So one is going to be a large cash flow impact due to the rupee depreciation. Second is, of course, the piling up of import liabilities is going to be there because having imported, if they have not been able to manufacture or sell, or having sold, if they have not been able to realize the money, the outstanding import liabilities are also going to increase. And this will have an impact on the liquidity issues. And corporates will have problems in liquidating these liabilities once situation opens up. So basically, there are problems on both the side for the importers and for the exporters. Liquidity is an issue, forex loss is an issue, catering to the business once they start. So all these are the issues which are going to bog the corporates the moment they start a business. Of course, we have been seeing the Reserve Bank of India and the Finance Ministry trying to come up with stops and other things, but there has been nothing major to take care of these two losses. They have been talking of putting liquidity in the market. Of course, we saw other problems in the stock market, the equity market collapse. We had this issue of the mutual fund also collapsing. One of the top mutual fund has called for liquidation, and that has also created a huge liquidity issue. And of course, RBI acted today by announcing a 50,000 crore liquidity to bail out this mutual fund. But as far as the FX part is concerned, at the moment, unless the rupee sees a correction or rupee situation improves, there's going to be a loss due to the rupee depreciation. So having said these two problems, I will go back to the solution or things what exporters can look at this point of time, and then the importers. Now coming to the exporters, the most important problem or the biggest problem they are facing is the loss due to cancellation of the forward contracts. Exporters who have not taken a PCFC or who have taken a packing credit in INR, or who have only sold dollar forward or to liquidate the export realization, and now due to cancellation of orders or non-goods or non-remittance by the buyers, the forward contracts have become naked, and that will incur a loss due to cancellation. Now, how do we address that? Now, there can be only one option. One is rupee, of course, has peaked at 76.80 and has slightly moved back. One simple thing is to just accept the mark-to-market loss and cancel it on a day where the rupee is slightly stronger and book the loss. Of course, that is going to create a large cash flow impact. But in fact, today there was a news item in Economic Time where SBI and PNB are offering unsecured loans to corporates to take care of this loss, so that it doesn't affect their liquidity or it doesn't affect their drawing power or their limits once things start. So maybe corporates could approach their bankers and ask them for some additional liquidity or some moratorium to settle the losses over a period, because RBI has been talking of this moratorium for people who have taken loan, people who have taken home loan, people who have taken other loans where they can approach their bankers and ask for a 3-month moratorium. So one way you could look at is just accept the loss on cancellation and try to come over it by having this moratorium or some facility from the bankers, and have a delayed payout of that one, which could be 2 to 3 months, and hopefully by that time the lockdown would have got lifted and things may start moving. Second could be possibly is, in case you corporates are hoping that exports are going to happen and they will be able to come back, they can use this dollar sold forward, the forward contract, and drop PCFC at the current dollar rupee rate. At least they will not have a cash flow impact, and take a PCFC longer and then use the future export receivable to liquidate the PCFC. To that extent, maybe the realization may be coming at a lesser amount, but they may not have an immediate cash flow, cash outflow due to the loss, due to cancellation of the forward contract. The third thing could also be that, you know, people could do a cancellation and rebook the forward contract for a further 6 months. So what can happen is at this point of time, they may incur a loss due to the cancellation, but the new forward contract would factor the current spot rate and the forward premium. So by that, at least, you know, if for any reason things improve, the rupee appreciate, those forward contract would be at a better rate and the future export can get converted at a higher dollar rupee rate. So this could be one of the way which you could use to address the liquidity impact due to the cancellation of the forward contract. Coming to the PCFC, again, a PCFC needs to be settled against export realization. And now with the situation, if the export realization doesn't come in, the PCFC could get crystallized at the current dollar rupee rate and it will be treated as a rupee drawdown and with a higher interest cost. Now, one thing we have been trying to talk to the couple of associations, mainly the textile people, we had a section to if they could approach the broker and see if this PCFC will be rolled over for a further 6 months, so that, you know, it doesn't result into non-performance and the higher interest cost. And maybe in future, when the export happens, the PCFC can be liquidated by that realization. So PCFC and currency can at least be managed from the situation either of these two measures. And then maybe, you know, buy time and then wait for things to improve and start liquidating the fresh PCFCs. The other area or the problem which is going to be there is on the open account exports. Now, till many years, most of the sellers or the exporters would have a very good relation with the buyers, and they may be having a relation by which most of the trades are happening on open account, and the payment would have been normally coming on time, and there was never a need to worry about a default or a delay due to that relation. Now, in the current scenario, post the COVID, there's going to be a change in the credit rating of most of the exporters, most of the buyers, or in fact across the globe, even the best of the companies are going to have some liquidity issues, and they may be asking for a revised credit terms, which may be longer credit. Plus, there could also be a possibility that, you know, they could reach a situation of a default or something if their situation doesn't improve once things come back to normalcy. So in this scenario, we feel that, you know, the credit insurance has to be given serious thought, or any sale, any export. In fact, even exports or sales could be considered with having a credit insurance factored for those sales. This will at least help to reduce the risk of default or delayed payment. Plus, the advantage will be a credit insurance could help an exporter to discount the receivable with any finance institution, either a overseas bank or a finance non-banking finance company who have appetite for trade finance, but they are comfortable having a trade credit insurance. In that, the advantage will be the risk gets shifted onto the insurance company and not the buyer. And as a seller, you will get your liquidity immediately on shipment or having done your side of the performance of contract. And it will be off balance sheet and help you to borrow without a collateral. So basically, it will be with off balance sheet and, you know, with a lesser collateral. So going ahead, exporters should revisit the way they look at relations, buyer relations, look at ways by which they can adopt a credit insurance so that the delays of payment or elongated credit period or the fear of default can be avoided. So these are something where an exporter could look at going ahead once we are seeing things come back to normalcy. I'll now come to the side of the importers. Again, just like we had problems for actually importers also are going to face problem, because many of the importers who had opened LCs or imported on a use-on period, they will now be faced with payment issues, and now liquidity is going to be a problem, because having imported, if they have not been able to sell or if they are not able to realize money, their import liability will have a cash flow issue, and they may run the risk of defaulting. So one solution which can be adopted here is do a rollover of the liability. Basically, before 2 years back, many of the import liabilities were rolled over under the buyer's credit road, which was typically under the LOU rate, that letter of undertaking, letter of comfort, which was banned after the Nirav Modi issues, and RBI did introduce another way of getting the rollover, which was on the back of a SBLC, or the standby letter of credit. However, this mechanism, though gives same advantage of a roller, but it has its own operational issues, and many bankers or branches of bankers or many of the corporates are not familiar with it, and it is not so popular. Of course, at this point of time, since that's the only way available, maybe corporate could start the process 1 week or 15 ahead of the due date and go through the process. In fact, our team will be more than happy to support in getting the quotes and also getting the rollover. But in the meantime, we have also suggested to a couple of the exporters, in terms of the textile exporters and other exporters, through maybe to make a representation to the Reserve Bank of India, whether they could revisit the LOU and introduce it maybe with some control, because that will help corporates to extend their liability easily, and also the operational procedures will be much faster, and even the smaller and medium-sized, mid-sized, small-sized companies can take advantage, and they can come over the current liquidity hangover, and may be able to defer these liabilities for some time. Coming to the future aspect of it, of course, now rupee is depreciated, and now any new contract are going to be at the current dollar rupee rate. But again, we have to wait and watch what is going to be the scene post lockdown being lifted, and how the different countries come back to normalcy, and where the rupee is going to head. But at least maybe till things come back to normalcy, longer credit period or import using the UPAS or the longer credit will help to tide over the current liquidity hangover. Fortunately, the cost of financing has not changed much because the LIBOR has fallen by almost 1% after the US cut interest rate. But because there is a liquidity hangover, and because the dollar liquidity is tight, the cost of financing has gone up. But overall basis, even pre-COVID and now, the costing is coming to somewhere around 2.5 to 3. That LIBOR plus 1.5 to 2, which is coming to 3%, and forward premium has also been around the 4%. So still, it is cheaper to borrow overseas under a longer credit on a fully hedged basis. Still, it can come within sub 9%. So at least till things get back to normalcy, or importers are strongly advised that they could import or using this UPAS route or any of the longer credit route, by which they can get a longer liquidity period, and manage the currency in a way that their effective cost is not high. So with that, basically these could be the immediate solutions which comes to our mind immediately, and maybe we could looking at the specific issues of the companies, we can address what we can help, and how we can help them in any of these issues. Now, having said this, we are now have to look at business from a new perspective, assuming that the lockdown get lifted post of May or somewhere in June we start. How to address business, how to look at things, because the whole scenario would have changed. The credit rating of the buyer, the seller would have changed. the liquidity parameters would have changed, the buyer's credit rating or the buyer's credit standing would have changed. So in that situation, Greenback can help various areas. So the first point or the first area where we can help corporates is to set up process by which all the risk, three risks, basically the risk due to currency volatility, risk due to any of the interest rate changes, and also the credit risk due to the change in the rating or of the buyers or the country. In that scenario, how to manage business so that this can be either mitigated or reduced, or even any default can be avoided. So we can help in designing and executing appropriate solutions to not only manage the liquidity, but also in ensuring that all the guidelines within the permitted guidelines of the central banks are adhered to, and the companies can go back to normalcy as fast as possible. The most important thing which we are now addressing post-COVID, and which corporates should look at, is the way they are doing their sales, especially both domestic and exports. Now, as I mentioned, many of the corporates are facing liquidity hangover, and the situation would be different once they come back to business, and definitely they may be in a different credit situation, and the ratings would have been downgraded by at least 2-3 notches, or the liquidity may not be the same to conduct the business they were doing earlier. So in that scenario, corporate should visit their relation and see how they can protect their cash flows by having this credit insurance factored while selling goods, both domestic and international. In fact, there are large international insurance brokers who have large relation with insurance firms globally, and depending on the country of your export and also your buyer's profile, the credit insurance can be structured, and once the credit insurance is structured, at least your risk of default is protected. Second is, the credit insurance helps a company to generate liquidity, or they will be able to have those receivable discounted by large banks or finance companies, and they can get their money well in time, and these are basically off balance sheet without recourse. So it will help them to get the liquidity faster, and since it is an off balance sheet, they don't have to worry about any issues regarding collateral. So broadly, these are the main areas where we have to look into once business starts, so that the pains doesn't repeat, or if the pains come again or from whatever form, at least you have prepared yourself to mitigate them by having all this in place. So summing up the whole discussion, I would like to mention that, in fact, I will hand over it to Manish, who is going to talk. We are going to conduct specific webinars on this credit insurance, which I talked about, then trade finance opportunity, which will help in liquidity, and the last will be the accounting issues, because when you do a transaction differently, we have to take care of the accounting issues pertaining as per the India. So we will communicate to you the dates, and we would be very happy to if you all can participate and at least have an understanding, and then maybe on a one-to-one basis, or if you have any requirement, our team will be more than happy to address this and educate, set up process, or build up the knowledge part from your people's perspective, so that they will be able to manage and handle this effectively. So I would like to end the discussion, and maybe hand over it to Manish, and then we can have a question and answer session. So friends, thank you so much for your patient listening, and I hope that this pain comes to an end, and government takes enough steps to lift the lockdown at the earliest possible. And of course, Bombay may not be in a hurry. Bombay and some other cities where the occurrence has been very large, it may take some more time. But yes, patience and belief and optimism will definitely help us to come over this times of pain and bounce back. And I'm confident that India is in a much better position, maybe to come back and we bounce back to normalcy. And if we adopt these things, maybe we will be able to do business better, and maybe we will be able to mitigate the loss or any defaults which could possibly happen as we go ahead. Thank you, friends.
Thank you, everybody, for participating in this webinar. We feel that I hope Subbu has addressed most of your concerns, and shortly we will be taking question and answers. I'm seeing a couple of questions already coming up. But in the meanwhile, I would request you to, give us your feedback on how you found this webinar. We plan to conduct the next webinar probably on May 1st, which is Friday, which will be the first topic, that is credit insurance for mitigating credit risk. I think credit risk has become a very important issue now, and today in an era where people are having a lot of difficulty managing cash flows, defaults are bound to happen, both domestically and internationally. And in this situation, any solution that will help you protect your receivables would be, I think, of great help to everybody. So we will soon be sending out an invitation for a webinar on credit risk. We request all of you to register if you are interested as soon as possible. There are only 100 slots available, and to avoid disappointment, I would request you to register as soon as possible. We will now move to the question and answer sessions, and we will be happy to take questions. You have a tab on your system called Q&A. Please post the Q&A or the questions by using the Q&A button in the Zoom app. If you have logged into YouTube, this webinar is being streamed live on YouTube. If you have logged into YouTube, unfortunately, we will not be able to take question and answers real time. But if you would send us a mail at advisory@greenback.in, we would be more than happy to revert back to you on email and address your concerns. You can always reach us at our email ID or our WhatsApp numbers. And if you're already working with us, you are always welcome to contact all your relationship managers, and we'll be more than happy to help you in these difficult times. So we'll now go over to the question and answers. We have 5 questions. So the first question is, what is the solution for forward contract losses in this situation? Whether RBI will intervene? Subbu, do you want to take that?
Okay, I had already addressed this situation. RBI at the moment seem to be just watching the market, and they have been, seeing that the rupee doesn't become very volatile, and RBI has always kept the stand of intervening only when there is excess volatility. Of course, we saw the rupee go one-sided, and it tested a low of 76.80, but now, the only solution could be, if you are cancelling the contract, maybe if there's still a time left, there could be occasion when rupee could slightly pull back. Like we saw on Friday, rupee tested 76. Today also it was slightly stronger. On a day when the rupee strengthens a little, you could look at cancelling those contracts and RBI at this point of time has not shown any signs of intervening, and there is no feelers also given where they look at the rupee. The only thing which can help the rupee to appreciate possibly is, of course, we have one silver lining or the positive, which is the Reliance deal with Facebook, which is going to bring in around $5.7 billion, and also hopes of more FDI coming in on the back of this resentment against China. those will happen little later. But if any of this indication, or if any indication comes even of lifting the lockdown partially, could send some positivity, and that could see a rupee correcting. But I think we should you should look at cancelling the contract if you are not able to export in future, or maybe do a rollover by cancelling at the spot and rolling out forward, and maybe at a future date when all the positives come in and rupee appreciate, that position may be better than the spot at that point of time. So either you cancel it on a day when the rupee slightly retraces, or roll it over for another 3 months for a future export performance.
Yeah, thanks, Subho. The next question is, what could be the best strategy to manage upcoming import invoices for which no forward cover has been taken?
Yeah, Manish, you can add that.
Yeah. So all I would say is today you are in a situation that you have not taken forward cover and the liabilities is falling due immediately. Reach out to your bank. The RBI has allowed banks to extend the working capital cycle, and if possible, go for a buyer's credit. A buyer's credit or an LC extension would help you defer the cash flow, and in future, as things go back to the normal, if rupee were to appreciate, at least you could have an advantage of a lower dollar rupee rate when you actually make the payout. I hope I have answered the question. The next question is there any cost difference for export factoring with and without recourse?
Manish,
yeah. So by definition, factoring is without recourse. What you do with recourse would be receivable financing. Obviously, when you do factoring without recourse, there will be an insurance cost, and insurance adds to the cost. When you do export receivable financing, which is with recourse, it is based upon your credit rating. Export factoring is based on the credit rating of your buyer. Hence, obviously, there would be a cost differential depending upon who has a stronger balance sheet, whether you have a stronger balance sheet or the buyer has a stronger balance sheet. So that is the way it goes. Hopefully, that should also answer your question. Thank you. The next question I have is regarding PCFC drawn at a lower rate before depreciation. Should we go with an approach to settle PCFC gradually, as and when it becomes due for payment, and draw further PCFC another 3 to 4 months at the current market rate? Please advise. Subho?
I think you can.
Okay. So again, coming back to PCFC, obviously you have drawn down at later rates. You have to settle it with the export remittances. In this case, I would say that yes, if you have more export orders and you can draw PCFC, keep drawing PCFC. We continue to believe that rupee is not going to permanently depreciate, and eventually the tide will turn. It's a matter of when and not if. And in this situation, I would strongly suggest that you keep your PCFC drawn down, and as and when the rupee appreciates, you will be in a position to actually, capture better rates and, average a better rate than what you would today. The next question is, why did RBI buy $2 billion in the first and the second week of April when there was so much pressure on the rupee?
Yeah, I think it's a very interesting question, and even we are also a little zapped as to why RBI. Of course, there should be definitely some reason for RBI to buy the dollar when there was no flows coming in, and also when the exporters were only cancelling, and at that point of time, if the rupee had appreciated, the losses would have been little lesser. But even we are stumped possibly why RBI had bought dollars. Maybe that's some reason which may only RBI knows. But yes, it is a very difficult question for us to answer, because RBI may have their own reason to buy.
The next question is, should the government or RBI not have a separate window for importers to buy USD at the bill of exchange rate for imports up to March to save importers from the 7% depreciation of the rupee in the month of March? So I will address that question. RBI always suggests that importers should be fully hedged. Now, RBI obviously is not going to come and bail you out, though they would sympathize with you. I don't think RBI is going to come and bail you out. You need to strengthen your risk management strategy here.
In fact, RBI comes and offers that window only for the oil companies, because that are bulk big payments and they often do it for such payment. But when it comes to importers, I think they leave it to the companies to manage their risk themselves by appropriate hedging mechanisms.
The next question is, in the interest of importers, why should forward cover not be compulsory? I will answer this, and I think RBI has time and again gone to banks and told banks to mandate forward cover as a compulsory thing for importers, and the importers lobby with RBI saying that we want flexibility. So RBI says, let the person who understands the risk manage the risk, and that is why they are saying that you need to have a risk management policy, which is important.
Okay.
The next question is, what is your view on dollar rupee in the near term and in the near future? Subho?
Yeah, I think, this will be the definite question I would have answered even if anyone had not asked. I think the rupee has depreciated almost 8% since the beginning of the year, and it peaked at 76.80, and thereafter it has been lingering at that level. Of course, we had the reasons for the rupee depreciation, and in fact, rupee was on a weaker note even before the COVID happened. We saw that rupee had initially depreciated by almost 3.5% up to March, and thereafter we saw the sharp depreciation of additional 5%. So yes, the rupee outlook at this point of time, till the lockdown, till this news keep coming, it's going to be on a weaker note. But I think the major negative has got factored, and of course, the other reason for rupee's weakness was the FI pulling out big chunk of money. In fact, it has reported almost $19 billion has been the outflow on account of both equity and debt, which FIs have pulled out. And of course, RBI had intervened to the extent of $12 billion that time, and that had led the rupee to depreciate lesser than what it would have if they had not intervened. Now, having said that, all the negatives have got factored in. Now we have to look at the positives. Now, biggest positive is the crude prices. In fact, crude has fallen to the lowest level, and in fact, we also had a situation of the May future being traded in negative. So, considering the fact that the whole world is slowed down and nobody will be in a fast track very soon, the crude will remain at the lower level, and that is going to be to our advantage. So with a lower crude price coupled with lower consumption, I think at least the first quarter is going to be a washout, and second quarter may just be picking up. The import bill is going to be very low, and that is going to be in our favor. So crude payment will be lower. Second is gold also has risen to such an extent that gold imports are also going to be falling very in a big way, and in fact, these two are the biggest component of our import bill. So with a lower crude price coupled with lesser consumption on crude and higher gold price, the import bills are going to be lesser. So the forward demand for dollar is going to be lesser. The other aspect which is also not going to put pressure on the demand is foreign travel. In fact, I think people who are traveling overseas, both on business, both on tourism, is going to fall drastically this year. One is out of fear of the COVID issue, so the import bills or dollar payment payouts is going to be very less. So we are going to see lesser demand. On the flip side is now the equity market has fallen over 30%, and now it has stabilized. And once the FIs are done with their settlement of their losses, I think India will once again be an attractive market, and we may see the bigger tranche of inflows coming in, and that could bring a rupee appreciation. So I think looking at these two aspects, we may see that rupee may stabilize around this level for the timing, and then correct. Of course, the other positive aspect is as mentioned by the Nitin Gadkari, that India has an opportunity to attract the FDI investment, because many of the countries who had their manufacturing, particularly China, are considering relocating their plants. Of course, Japan has already offered $2.5 billion plus to their companies to move out of Japan. So India could, use this opportunity to attract that. Of course, Vietnam has been attracting, but even if we get some portion, that could also help in a long-term inflows, and that could also be positive. So with all this, and of course now exports are also started. Many of the pharma companies and specialty chemicals companies have already started manufacturing, and exports will start picking up. So I think we may see the rupee correcting at least by 1 or 2%, and I won't be surprised if it moves below 75. But yes, it is the trend will be when the lockdown is going to get lifted, and when indication comes that the supply chain and the manufacturing things are coming back to normalcy. But as of now, the rupee weakness is almost over, and the maximum it can go maybe 76, 80 or maximum 77, and thereafter a small pullback.
Yeah. Uh, the next question is this the right time to draw PCFC? So as Subbu touched earlier, yes, I would look at it in two perspectives. One, given the liquidity situation in the market today, a lot of companies are holding cash, and the reason we have, a sharp drop in dollar liquidity is because global companies have gone out and drawn down their working capital lines and are holding cash. In this situation, just from a perspective of holding cash, drawing down PCFC is available is very important, and it should be drawn down. On the other hand, we could get into a situation where we look at PCFC drawdown from an exchange rate perspective. From an exchange rate perspective, today we are probably around 77. It's very difficult to say whether this is a top or not, but given the fact that we are nearly at the top of the problem in terms of though the numbers are increasing of COVID, probably the pace has slowed down, and probably we should peak soon. Given the fact that that could be the case, it might be a good idea, even from an exchange rate perspective, to draw down PCFC now. The next question is, it's addressed to Subbu. Few solutions provided by you gave a view that rupee should appreciate. Is that your view? What is the best and worst case scenario for rupee going forward according to you?
Shadul, I think I have come to this point of the rupee outlook based on the factors and other thing. Yes, it is my view. But yes, again, the other side could also happen if, the COVID problem or the numbers rise and the lockdown is extended, and again, the equity market sees some pain or something. So ideally, what could a corporate do? Basically, manage their exposures in a way that, benchmark it and have hedging instruments which will take care of a scenario either way. So a blend of forward coupled with some options, even if option amount to paying some premium, will help you to at least mitigate either situation. Now, the advantage of an option is that it can give a protection if it goes against you, and a participation if it is in your favor. So though that the problems are over, and though the other parameters are indicating that we may see a rupee correction, but yes, we never know whether we are at the end of the tunnel, or whether there could be some more pain. So the best way is to have a view and have the hedging instrument in a way which could blend the view in such a way that if you are very bullish, then have a smaller component of option. But if you are seeing a situation that it could be either way, maybe try to have a little more higher component of option. But yes, I think now option will play an important role in the way hedging is done, and till things come back to normalcy.
Yeah, thanks, Subbu. The next question that we have is, again, touching over these option issues. For future hedging of either rollovers or fresh exposures, don't option play an important role, partly as the market is likely to be extremely volatile in the next 6 to 8 months? I think Subbu just answered this question. Options are going to play an important role, and we would always suggest clients to have a mix rather than, have any one instrument which you are extremely bullish on. So having a mix between forwards, options, and some other strategies could probably be the way to go. I have answered all the questions. I and Subbu have managed to answer all the questions. If there are any other questions, please fire. We'll wait for another couple of minutes before we sign off. Well, friends, I think we come to the end of this webinar. I hope you all enjoyed it. Oh, I'm seeing another question. Okay, let me try and have a look at it.
Thank you, friend. Thank you for
Okay.
your patience.
Thank you very
hearing
much.
and,
Yeah, we will look forward to seeing you in the future webinars. We will shortly communicate with you and we will appreciate your feedback. Thank you very much. Stay safe.
yeah.
Goodbye.
Thanks, friends. Goodbye. Manish, ठीक था?